There are 3 documented moments in Bitcoin's history that prove something uncomfortable. The biggest threat to your Bitcoin was never the market. It was the moment you stopped trusting yourself to hold. 2 of these moments happened years ago, and the third is happening right now, in real time, to people watching this exact video. One involves a programmer who bought 2 pizzas for what is now worth close to $1 billion. Another involves a developer who literally helped write Bitcoin's original code and still sold early. The third is not a story at all. It is a live statistical snapshot of thousands of holders under pressure in 2026, and the data inside it will tell you, uncomfortably precisely, which group you already belong to. By the end of this video, you will know exactly why intelligence, technical knowledge, and even direct access to Satoshi Nakamoto himself were not enough to protect 2 of the most capable people ever involved with this technology. And you will know exactly what the data says about people holding Bitcoin at this very moment, including, statistically speaking, some of the people watching this video right now. Stay with me until the third case, because that one is not history, it is a mirror. Most content about Bitcoin focuses entirely on charts, catalysts, and macro narratives, as though the only variable that matters is what the market does next. And this video is deliberately built around a different variable, one that almost never gets the same amount of screen time. It is the variable sitting on your side of the screen, not the market's side, and it turns out to be the one responsible for nearly every documented case of life-changing wealth lost after the fact. Before we go further, let's be honest about who tends to tune out of a video like this. Some viewers hear psychological mistakes and assume it applies to beginners, to people who bought Bitcoin last month and panic at the first red candle. That assumption is wrong, and this video is going to prove it wrong using the strongest possible evidence. The second case in this video involves a person with more technical understanding of Bitcoin than the vast majority of people who will ever hold it. He helped write the code. He understood the cryptography, the incentive structure, and the long-term thesis at a level almost nobody watching this video ever will. None of that protected him from the exact same psychological failure that catches complete beginners. That is the entire point of this video, stated plainly at the top. Technical knowledge and holder psychology are 2 completely separate skill sets, and mastering one does nothing to guarantee the other. If you have ever assumed your understanding of Bitcoin's fundamentals makes you immune to panic or impatience, this video is built specifically to test that assumption against real, documented cases. We are covering 3 of them today, moving from the distant past toward the present moment. Each one strips away a different excuse. By the time we reach the third case, there will be no excuse left standing, only a direct question about which group you are actually in. Before we open the first case, it helps to name the pattern we are actually tracking across all 3 stories, so you can watch for it as it repeats. In every one of these cases, the person involved was not confused about facts. Laszlo knew exactly what he was trading. Malmi understood the technology better than almost anyone on Earth at the time. The holders in the 2026 survey have more historical data about Bitcoin's recovery cycles available to them than any previous generation of holders ever had. And yet, in every single case, a meaningful share of people still made the same category of decision under pressure. That repetition is the entire argument of this video. If the failure point were really about information, better information should have produced a better outcome each time, and it consistently does not. The honest bear case for this whole framing has to be set up front, not saved for later. It is entirely possible that what looks like a mindset failure from the outside is, in each case, simply the correct decision given each person's actual life circumstances at the time. And that framing normal human behavior as a psychological flaw is itself a marketing narrative built backward from outcomes nobody could have predicted going forward. That objection deserves to sit next to every case in this video, not just to get raised once and dismissed. With that in mind, let's start with the first case, the one most people have already heard part of, without ever hearing the full context behind it. Before we get into the first case, a quick note on sourcing, because that matters on this channel. The facts in this first case come from Laszlo Hanyec's own public forum posts from 2010, corroborated by financial reporting that has tracked and verified this story for over a decade. Nothing here is speculation, and nothing here is exaggerated for effect. The numbers are large enough on their own. On May 22, 2010, a Florida-based programmer named Laszlo Hanyec did something nobody had ever done before. He paid 10,000 Bitcoin for 2 pizzas, marking the first documented commercial transaction in Bitcoin's entire history. At the time, Bitcoin had no established market value, no reliable exchange, and no reference price that anyone could point to. Laszlo had been mining coins on his own home computer, treating them as little more than an internet experiment. He posted an offer on the Bitcoin Talk forum, proposing 10,000 Bitcoin in exchange for 2 large pizzas. Another user accepted, ordered the pizzas from Papa John's, and had them delivered directly to Laszlo's house. It's worth sitting with how early this actually was in Bitcoin's timeline. There was no major exchange handling meaningful volume yet, no app on anyone's phone, and no price ticker anywhere to check. Mining was still something a person could reasonably do from a home computer, which tells you how small and experimental the entire network still was at that exact moment in history. Here's the number that breaks most audiences the first time they hear it. Today, the value of those same 10,000 Bitcoin is close to $1 billion. 2 pizzas, purchased with what is now worth roughly $1 billion. Now here is where most retellings of this story get the lesson completely wrong, and where this channel is going to take a different approach. The easy version of this story frames Laszlo as foolish, as a punchline, as proof that some people simply cannot see value coming. That framing is lazy, and worse, it is historically inaccurate. In the context of May 2010, Laszlo's decision was entirely rational. Bitcoin, at that exact moment in its existence, had no function other than to be spent, tested, and circulated. The publicly stated purpose of the project at the time was to demonstrate a working peer-to-peer digital currency, not to serve as a long-term store of value. Laszlo did not make an information error. He made the correct decision given every piece of information available to him at the time, and he still ended up losing what is now an extraordinary fortune. No amount of research available in 2010 could have psychologically prepared anyone for what came after, because nothing like it had ever happened before in financial history. This is the turning point of the entire block, so listen closely. Laszlo's mistake was not cognitive, it was structural. He had no mental framework for handling a non-linearly appreciating asset, and the honest truth is that nobody did in 2010 because that framework simply did not exist yet. Anyone holding Bitcoin today has access to that framework. It exists now, documented, studied, and available to anyone willing to build the mindset around it. The uncomfortable question this case leaves you with is simple. Are you actually using that framework in your own decisions? Or are you operating with the same absence of mental structure Laszlo had in 2010, except now with far more at stake? Now, the bear case, because we cover it on every single block on this channel, no exceptions. Skeptics point to exactly this kind of story as proof of Bitcoin's core weakness rather than its core strength. If an asset's founding transactions look absurd only in hindsight, the argument goes, that says more about extreme volatility and unpredictability than it does about any special kind of wisdom in holding. A skeptic would say hindsight bias is doing all the work in this story, that it is easy to praise holding once you already know the ending, and that thousands of other early transactions from that same era simply never get told because they didn't turn into a dramatic number. That is a fair objection, and it deserves to be said plainly rather than dismissed. Whether the lesson here is really about mindset or whether it is survivorship bias dressed up as a parable is something every viewer has to weigh for themselves. It's also worth noting that Laszlo has spoken about this transaction himself in later years, without bitterness, treating it as a meaningful part of Bitcoin's origin story rather than a personal tragedy. That framing matters because it suggests the lesson in this story was never really about regret at all. It was about this specific narrow gap between what a person could reasonably know at the time and what the asset eventually became, a gap that simply does not exist the same way for anyone holding Bitcoin today. Here is the line worth remembering from this first case. He didn't make the mistake out of stupidity. He made it because, like everyone at the time, he had no reason to believe 2 pizzas would one day be worth more than an apartment in any capital city on earth. I want to pause here for a moment because this exact gap, the difference between understanding an asset and actually having the psychological structure to hold it, is the entire reason we built the Bitcoin Holder Mindset ebook. It is not a trading guide, and it does not tell you when to buy or sell. It is a framework specifically for the moment your own emotions become the biggest risk in your portfolio, which, if the next 2 cases are any indication, happens to almost everyone eventually. The ebook is normally $97. Stay with me through the rest of this video because before we're done, I'm going to hand you a code worth $50 off that price. Keep that in mind. We're moving now to a case that makes Laszlo's story look almost simple by comparison. Before we go into this next case, another quick sourcing note. The details here come from Martti Malmi's own public statements, cross-referenced against reporting that has documented his role in Bitcoin's early development. This is not a rumor circulating in forums. This is a well-documented, on-the-record account from one of the people who was actually there. Martti Malmi is a Finnish programmer, and he was one of the very first code contributors to Bitcoin, working directly alongside Satoshi Nakamoto in the project's earliest days. He mined Bitcoin on his own laptop between 2009 and 2010, back when the entire network was small enough to run from a personal computer. He was not a passive observer of Bitcoin's rise. He helped build the foundation it was rising from. Malmi's involvement went well beyond writing code in isolation. He handled significant parts of Bitcoin's early public-facing presence, corresponding directly with Satoshi Nakamoto during a period when the entire project's future was genuinely uncertain. Very few people in Bitcoin's history have ever had that level of direct, sustained insight into both the technology and the intentions behind it. Malmi sold 55,000 Bitcoin, with most of that total sold before 2012. This was not a crisis of confidence in the technology itself. He needed money to live, and he used part of the proceeds to buy a small apartment, leave a programming job he found boring, and spend 2 months studying Japanese in Japan. Here's the number that should genuinely stop you. Those same 55,000 Bitcoin are worth approximately $1.2 billion today. A small apartment, a career change, and a language trip, purchased with what would now be one of the largest personal fortunes in the world. Years later, Malmi spoke publicly about that decision, and his own words are worth hearing directly rather than paraphrased. He called the decision regretful, but added that he and the other early Bitcoiners, in his words, set in motion something greater than personal gain. That is not a man pretending he has no regrets. That is a man being honest about the trade-off he made. Here is why this case matters more than Laszlo's for the argument we are building in this video. Laszlo's story proves that nobody had enough information in 2010 to predict what was coming, and that is a fair and complete explanation on its own. Malmi's story proves something considerably more uncomfortable because he did not lack information the way Laszlo did. Malmi understood the technology at a level that 99.9% of current Bitcoin holders never will and never will need to. He did not need to be convinced that Bitcoin had long-term potential, because he was one of the people actively building that potential with his own hands. And it still was not enough to keep him holding. This is the pivot the entire video is built around. Technical knowledge and holder psychology are not the same skill, and one does not transfer into the other automatically. If direct authorship of the code was not sufficient to produce the mindset required to hold, then reading a white paper, watching some videos, or feeling confident about the fundamentals is almost certainly not sufficient either. The psychological mechanism at work here has a name, and it is worth knowing. It is called hyperbolic discounting, and it describes the brain's tendency to overvalue a certain immediate reward relative to an uncertain, distant future reward, even when the long-term math overwhelmingly favors waiting. An apartment now, a trip now, freedom from a boring job now, all of these are concrete and immediate, while a fortune 10 years in the future is abstract, no matter how large the eventual number turns out to be. Malmi did not need a better argument for why Bitcoin might succeed. He needed a decision-making structure strong enough to withstand the pressure of an immediate, practical need. He did not have one, because at that point in Bitcoin's history, almost nobody did, and the ones who built that structure later mostly built it the hard way, through direct financial regret. Now, the bear case for this one, because it is arguably the strongest bear case in the entire video. A skeptic could reasonably argue that Malmi's story does not prove holder psychology can be trained. It proves the opposite. The markets are fundamentally unpredictable to everyone, insiders included, and that any framework claiming to fix this is unfalsifiable nonsense dressed up as wisdom after the fact. If the person who helped write the code could not have predicted the outcome, the argument goes that no framework, no mindset training, and no amount of discipline can reliably predict it for anyone else either. This is a genuinely serious objection, not a straw man, and it deserves to sit uncomfortably next to the rest of this case rather than being brushed aside. The honest answer is that a framework does not promise prediction. It only changes how a person behaves under uncertainty, which is a narrower and more defensible claim than promising foresight. Here is the line to remember from this case. If the guy who helped write Bitcoin's code didn't have the mindset to hold, what makes you think you will, with no preparation at all? If these two stories are landing for you the way they landed for me the first time I researched them, so this reaches someone else who needs to hear it, and subscribe, because we are about to move from history into something happening right now, in real time, with real numbers attached to it. Before we get into that third case, I want to name something directly. Every single story in this video follows the same shape. A person has access to information, sometimes overwhelming amounts of it, and the information alone is never the deciding factor in whether they hold. What decides it is whether they have built a mindset capable of absorbing pressure without collapsing into an emotional decision. That is the exact gap the Bitcoin Holder Mindset ebook was built to close. Inside it, you'll find the specific psychological patterns behind selling too soon, panic selling during a crash, and FOMO buying at the top, the same three patterns you are watching play out across these three cases in real time. It walks through concrete frameworks for recognizing which pattern you are most vulnerable to before the market forces you to find out the hard way. The ebook is normally $97, and the $50 discount I mentioned earlier still applies, bringing your total down to $47. I'm not giving you the code yet, because the final case we are about to cover is the one that makes this decision easiest to understand. I want you to see the full picture before you act on it. Stay with me. One more sourcing note before this final case, and it matters more here than anywhere else in the video, because these numbers are recent and time-sensitive. The sentiment data referenced here comes from a Bitcoin holder survey conducted in March of 2026, and the on-chain figures come from blockchain analytics reporting published during the same correction. Unlike the first two cases, this is not settled history. This is a live snapshot, and it will continue to be verified and updated as new data comes in. This final case is different from the first two in a fundamental way. It is not one person's story. It is a real-time statistical and on-chain snapshot of thousands of Bitcoin holders under pressure, captured during an actual market correction in 2026. That difference matters because it means this case is not asking you to learn from someone else's past mistake. It is asking you to locate yourself inside a data set that is being written right now. Let's start with the sentiment survey, because it may be the single strongest statistic in this entire video. A survey of Bitcoin holders conducted in March of 2026 mapped the real emotional state of people holding the asset during that period. Anxiety was the dominant emotion reported, cited by 39% of respondents, closely followed by hope at 38%. Here's the detail that matters most from that survey. Fear alone rarely triggers the actual decision to sell, and the data backs that up directly. 69% of respondents had not sold anything at all, and said they planned to keep holding regardless of conditions, meaning that what people sometimes call diamond hands is, statistically, the norm rather than the exception among this group. Only 8% of respondents qualified as true panic sellers, defined in the survey as people who both sold during the downturn and said they would sell even more if conditions worsened further. That is a small minority driving an outsized amount of damage, both to their own portfolios and to short-term market pressure generally. And despite the correction itself, 66% of holders surveyed still believed Bitcoin would eventually set a new high, meaning even a sizable share of the anxious majority had not actually lost their long-term thesis. Sit with those numbers for a second, because they translate directly into a question you can ask yourself right now. 69% hold, 8% panic, and according to the data, make their own losses worse in the process. The real question is not what you would say you'd do in a downturn. It's what you actually did the last time Bitcoin dropped 20% in a single week. Now let's move from the survey data, which is self-reported opinion, to the on-chain data, which is not opinion at all. During a correction in 2026, on-chain analysis showed that more than $770 million in Bitcoin was sold at a loss by distressed short-term holders in a single downward move. At the same time, longer-term holders overwhelmingly kept their positions intact through that same window. At another point during that same correction, monthly realized losses reached a record $90 million, a figure that exceeded losses recorded during previous capitulation phases earlier in the cycle. The most recent buyers absorbed the largest share of those losses, specifically because they had entered the market at higher prices and had far less room to absorb a downturn before their position moved into the red. This is not a story about Bitcoin failing. It is a story about the exact same psychological pattern from Laszlo and Malmi playing out at scale in public, with dollar figures attached in real time. The on-chain analysts covering this correction summarized the entire mechanism in a single phrase, and it is strong enough to work as a title card on its own. Weaker hands continue transferring Bitcoin to investors with stronger conviction. Read that sentence again, because it is describing exactly what happened to Laszlo's coins, exactly what happened to Malmi's coins, and exactly what is happening to someone's coins again, right now, during this exact correction. The psychological mechanism driving this behavior combines two forces working together. The first is loss aversion, the well-documented tendency for the pain of a loss to feel significantly more intense than the pleasure of an equivalent gain. The second is recency bias, the brain's tendency to treat the last few days of price action as though they represent a permanent new reality, rather than one data point inside a much longer and historically volatile pattern. Under pressure, these two forces combine to make a temporary paper loss feel more urgent and more real than any amount of documented historical recovery sitting in the record. Industry research on this exact pattern reinforces the point directly. Investors who enter a market during its most euphoric phase tend to feel the strongest compulsion to sell once their portfolio value drops sharply, which is precisely the mechanism that has historically marked the bottom of previous bear market cycles rather than the beginning of a collapse. That is the uncomfortable irony sitting underneath this entire case. Panic doesn't just destroy wealth in the moment it happens. It tends to happen at almost exactly the worst possible time to act on it, which is precisely why the 8% in that survey are the group losing the most, both financially and arguably psychologically. This is not the first time this exact pattern has shown up in Bitcoin's history, and it will almost certainly not be the last. Earlier corrections across previous market cycles produced similar splits between holders who stayed and holders who capitulated near local bottoms. And in each of those earlier cycles, the same on-chain language of weak hands to strong hands showed up in the data afterward. None of this is a promise about what happens next, and this channel does not make price predictions in either direction. but the historical shape of the pattern itself is well documented across more than one cycle, not unique to right now. Now, the bear case, because even this data-driven case deserves one, and pretending otherwise would be intellectually dishonest. A skeptic looking at these same numbers could argue the opposite conclusion entirely. $770 million sold at a loss in a single move, and a record $90 million in monthly realized losses are not proof of an overreaction. They could just as easily be read as evidence of genuine structural fragility, excessive leverage in the system, and a market that is more speculative than its long-term holders want to admit. Under that reading, weaker hands transferring to stronger hands is not a reassuring pattern at all. It is simply what capitulation looks like partway through, with no guarantee that the correction is actually finished rather than merely paused. Nobody watching this video, including this channel, can responsibly tell you which reading turns out to be correct in advance. And any voice that claims certainty about where this goes next should be treated with real skepticism, regardless of which direction that certainty points. Here's the line that ties this entire video together, and it is worth remembering on its own. The numbers don't lie. Most people hold. A minority panics and pays the highest possible price at the worst possible moment. And the difference between those two groups isn't luck, and it isn't how much money either of them started with. It's mindset, and mindset is the one part of this entire equation that can actually be trained in advance. 3 cases, 3 completely different eras, and one identical pattern running underneath all of them. A programmer with no information framework in 2010, a developer with more technical knowledge than almost anyone alive, and still no psychological structure to match it. And right now, in 2026, thousands of ordinary holders splitting into the same 2 groups in real time with real dollar figures attached to the outcome. Information was never the missing piece in any of these 3 cases. Laszlo had all the information available at the time. Malmi had more information than almost anyone on Earth. The people capitulating in 2026 have access to more historical data about Bitcoin's recovery patterns than any generation of holders before them, and a meaningful percentage of them are still selling at the bottom anyway. I want to be precise about what this video is not claiming, because it matters. This is not a video telling you Bitcoin is guaranteed to recover from any specific correction, and this channel never makes calls about price direction in either direction. Nobody, including every analyst, every fund, and every person who has ever appeared on this channel, can reliably tell you what happens to price next week, next month, or next year. What the data across all 3 cases actually supports is narrower and more defensible than a price call. It supports the observation that reactive, pressure-driven decisions have historically cost the people who made them more than a longer holding period would have across multiple completely different eras of this asset's history. That is a statement about behavior, not about future price. And the bear case here deserves to be repeated one more time before we close. Past behavioral patterns are not a guarantee that this time behaves the same way. And anyone who tells you otherwise with total confidence is selling certainty that does not actually exist in financial markets. Here's your code, as promised. The Bitcoin Holder Mindset ebook exists specifically to close the gap this entire video has been describing. The space between understanding an asset intellectually and having the psychological structure to actually hold it through pressure. It is built around the exact patterns behind all 3 cases you just watched. Selling too soon out of impatience, panic selling during a downturn, and FOMO buying at emotional highs, along with practical frameworks for recognizing each pattern in yourself before it costs you. The ebook is normally $97. Use the code HOLDER50 at checkout, and $50 comes off immediately, bringing your total down to $47. The link is directly below this video. Click it, add the ebook to your cart, and enter HOLDER50 before you complete checkout. This isn't a course, and it isn't hours of content you'll never get through. It's a focused, practical framework built specifically around the 3 patterns covered in this video, designed to be read and actually applied before your next moment of real market pressure, not filed away for someday. Here's the question I want you to actually sit with, not just hear and move past. Laszlo had no framework and lost what is now worth close to $1 billion. Malmi had more knowledge than almost anyone on the planet and still sold 55,000 Bitcoin worth over $1 billion today. Which of those 2 gaps do you currently have? The information gap or the mindset gap? And what are you doing about it before the next correction turns you into a 4th case study instead of someone learning from the first 3? Let's walk through what we covered, one case at a time before we close. Case 1 showed that even perfect information for its time could not prepare Laszlo Hanyecz for a non-linear outcome nobody could have modeled in 2010, and that his choice was not stupidity, it was the absence of a framework nobody had yet built. Case 2 pushed that same idea further, because Marty Malmi did not lack information the way Laszlo did. He had more technical understanding of Bitcoin than almost anyone alive, and it still was not enough to keep him holding through an ordinary human need for money, freedom, and a fresh start. Case 3 showed that this same pattern is not confined to the past at all, and that right now in 2026, real holders are splitting into the same two groups with real dollar figures, separating them in a live, ongoing correction. Every one of these cases points toward the same conclusion, even though each one arrived there through a completely different door. The market did not defeat Laszlo, and the market did not defeat Malmi, and the market alone is not what defeated the 8% of panic sellers identified in that 2026 survey. In each case, an untrained psychological response to pressure did the damage, not a lack of intelligence, and not a lack of access to information. And that specific problem is one that can actually be prepared for in advance, unlike the market itself. Here's a short, practical way to hold on to everything covered in this video. Before your next moment of genuine pressure, whether that's a sudden need for cash, a sharp red week, or a euphoric green one, ask yourself which of the three patterns you're most likely to fall into. Selling too soon like Laszlo, selling under quiet personal pressure like Malmi, or reacting to fear or hype the way the 8% did in 2026. Naming the pattern in advance, before it actually happens to you, is a large part of what separates a prepared holder from a future fourth case study. If this video reframed anything for you, share it with someone else in your portfolio conversations who needs to hear it, because the mindset gap described in this video costs real people, real fortunes every single cycle, not just the three examples we covered today. There are dozens of similar documented cases across Bitcoin's history that never make it into mainstream coverage, simply because the dollar figures involved are smaller, or the story is less dramatic than a pizza worth $1 billion. The underlying mechanism in every one of them is identical to what you just watched play out 3 times in a row. Subscribe, because we are continuing this series with more documented cases and more current on-chain data as this cycle develops, and because the 2026 data we covered today is still being written in real time. I'll see you in the next one. This video is for educational and informational purposes only and does not constitute financial advice. Bitcoin and other digital assets are highly volatile, and past outcomes referenced in these case studies do not predict future performance. Always do your own research and consult a licensed financial advisor before making any investment decisions.